policymakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fed Chair Jay Powell takes a March rate cut off the table and says the job's not quite done.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks.
Well, China vows to stabilize markets after last week's stock slide. Meanwhile, Donald Trump warns he'll impose tariffs of 60% or more on Chinese goods if elected. Plus, UniCredit soars as the Italian lender smashes expectations and says it will return 100% of net profits to investors this year. So let's take a look at the European markets map. Again, a lot of questions about what we heard from Jay Powell. Treasuries actually extending some of the sell-off that we saw on Friday. That's, of course, filtering through here to Europe. You can see we're trading without much conviction. The CAC 40 is pretty much flat. The DAX is pretty much flat. And the FTSE 100 gained some 0.4%. UniCredit giving a lift to the FTSE MIB as a whole. That index is actually gaining some 0.8%. Again, policymakers will likely wait a little bit more for clues beyond March before understanding fully what Jay Powell will do beyond March. Chinese stocks also saw quite a lot of volatile and quite a lot of wild swings. Again, it just goes into the psyche of investors as we start a new week, not really knowing quite where to go, and then earnings season continuing. Now, to talk all about these markets, we're joined by Laura Cooper, BlackRock's Senior Macro Strategist for iShares EMEA. Laura, as always, thank you so much for joining us. There's a lot going on, but it's all about inflation overall and actually what Jay Powell does and doesn't do. I mean, are they worried? Does the U.S. jobs market and data that we saw on Friday, coupled with what he says, actually delay cuts by quite significantly?
I think they do delay cuts, probably until middle of this year. I mean, he'd already echoed the fact that they're not going to cut in March. And I think markets will be watching that data. It was interesting, actually, after the payrolls report, we had Fed member Bowman come out and say essentially that this is an environment where, we potentially aren't seeing the type of loosening in the labor market, that rebalancing that they had expected, which could in turn lead to elevated wage pressures and even stickier core inflation. So the fact that markets are extrapolating this disinflationary trend through the end of the year, I think there's a little bit more scope for that rates repricing to come through and for markets to even price out maybe a potential May cut as well.
So how difficult actually is it to explain the jobs market right now? Again, we don't exactly know also if inflation's coming down because of central bank action. And if it's not, it makes it all more wobbly.
Yeah, and it's a great question. I think when we saw the payrolls print on Friday, we were certainly surprised. I mean, there were some seasonal distortions that perhaps lead some caution to that overall headline print. And as well, the wage number was really quite surprising at 0.6% month on month. Again, we did have a drop in average hours worked, largely due to this colder than expected January. So it's hard to read through onto that number as well. But I think taking a step back from the FOMC last week, Jerome Powell said, we're shifting back to that dual mandate. We are seeing signs of rebalancing in the labor market. I think Friday's data does put a bit of a jolt in that, and I would expect that the front end, we have seen those rate cuts, pared back slightly. There's probably a little bit more room for that to really materialize, and the key question is what impact will that have overall on equity markets?
So if you look at central banks around the world, is it clear that actually the Fed has to go first before the ECB or the Bank of England move? Or could the ECB go first?
I don't think it's clear that the Fed will go first, certainly given the U.S. exceptionalism that continues to come through in the U.S. economy, whereas in Europe, yes, it avoided a recession in the latter half of last year, but clearly those leading economic gauges continue to show signs of challenges, particularly in Germany, against a backdrop where inflation is decelerating at a much quicker pace. Essentially, we're going to be at that 2% target much sooner than what we expect in the U.S. Now, that said, we're leaning against the ECB cutting before the Fed. Typically, we don't see them cut before the Fed. But as well, they've really emphasized the wage data. That was a clear kind of takeaway in Christine Lagarde's presser. So I think they're going to wait to get clarity on those Q1 wage negotiations before they actually cut in June. But the question then is they'll likely cut much more steeply than what we expect to come through in the U.S.
So does it mean that markets will be a lot more volatile until we have more clarity on wages?
I think there is a degree of uncertainty still to be had, given that we are seeing, rates markets still price in about that 5 cuts from the ECB. I mean, I would argue that's pretty fair in kind of looking at the forward path. But again, it's all about the messaging coming through. And it's clearly central banks that continue to emphasize this data dependency. If we do start to see some upward surprises, that's going to emphasize this higher for longer rates backdrop. And I think that has repercussions not only for equities, but as well for the rates market. And the key is, where to position in this, probably extending some duration in Europe, but still remaining quite cautious in front-end exposures in the U.S.
And so, Laura, what do you do with the Bank of England and the UK right now?
The Bank of England is an interesting one. I mean, certainly the fact that last week's presser, we did see the signs that they abandoned their tightening bias, which is something that we had expected. Certainly the economic backdrop continues to be challenged. If anything, we think there's scope for more rate cuts to be priced in this year, just looking at the implied policy path, because, there is this scope of fiscal uncertainty given the election. But I think overall, this is still a challenging backdrop, and I think that's going to trump what we're seeing from the inflation dynamics.
I mean, it was a 3-way split. I know it was only 2 votes actually for a hike, but it's pretty extraordinary. And also the governor would just not commit he wouldn't commit to the fact that the next move is definitely a cut. Could we see a hike if, if there's a lot of this uncertainty with renewed wage pressure?
And I think that's the key question facing markets. Certainly, we did see that upside surprise in UK CPI a couple of weeks ago, the US payrolls print. I mean, there's a number of uncertainties still about the macro outlook. And I think that's why markets are getting slightly ahead of themselves in kind of pricing in these aggressive easing cycles through the end of the year when central banks are emphasizing the data-dependent approach. And that data is going to be volatile over the coming months, which does suggest, there's a lack of clarity on what the policy paths could actually turn out to be.
So interesting. Laura, thank you so much. Laura Cooper, their Senior Macro Strategist for iShares EMEA at BlackRock, stays with us. We have many questions also about China. Now, the chief executive of one of the world's biggest insurance companies has told Bloomberg that he intends to scale up the business despite current global volatility. Well, speaking to David Rubenstein, the AXA chief executive, Thomas Buberl, also discussed how he plans to manage the transition to lower interest rates and inflation.
Obviously, these changes produce a high volatility of the economic environment, and certainly we spoke earlier about the geopolitical environment. So in a highly volatile and highly unpredictable environment, it is important to take a strategy of low risk. And so essentially what we have said, we have built now a platform that is working very well. We are the biggest insurer now of enterprises across the world. We are one of the biggest in Europe. We want to make sure that we scale up this business more in the next phase.
Okay, let's talk about the economy. The United States has a situation where we have reasonably good growth in 2023, over 3%. Europe has not grown quite as well. Why do you think the United States seems to be pulling away from the European and Chinese economies in terms of our growth? Is it something about the American business environment that the United States has recovered from COVID maybe better than Europe did or China did?
So I think there's a couple of factors. Number one is fiscal stimulus. The fiscal stimulus in the US was much higher than it was in Europe, and obviously fiscal stimulus leads to more demand. Secondly, there is a lot of onshoring happening or reshoring happening from somewhere else into the US, which is obviously something that creates growth as well. And then thirdly, when you look at your demography, this is much healthier than what we have in Europe.
Or do you worry about Russia, Ukraine as a potential insurance risk?
I mean, we worry a lot about these risks because, these risks do create claims. And so the Russia-Ukraine situation did create a lot of claims on the political risk side, on the marine side, on the aviation side. So for us, it's important to look out for them and certainly also to see where the next crisis comes from. Because even if the Ukraine-Russia crisis was to be resolved, I'm sure the next crisis is coming. Look what is happening in the Red Sea now, which again has massive implications around maritime transport, war cover for maritime transport, supply chain risk, and so on. So I project myself in a world now in which we see many, many more of these crises happening, and we need to deal with it.
Well, that was the AXA chief executive, Thomas Buberl, speaking to David Rubenstein. You'll be able to see more of that interview in a new episode of the David Rubenstein Show, peer-to-peer conversations, coming soon on Bloomberg TV. Now, coming up, stability continues to elude Turkish monetary policy as the lira as a central bank sees another abrupt leadership change. More on that next, and this is Bloomberg. Well, still with us, BlackRock Senior Macro Strategist for iShares EMEA, Laura Cooper. Laura, thank you so much for sticking around. We're talking about ECB, we're talking about the Fed, we're talking about the Bank of England. I mean, this, of course, is in the middle of earnings season.
Yes.
Like, I don't know if there's a general theme of how things are going or how many cost cuts are happening.
Well, I think there's one theme emerging if we think about U.S. earnings, and that's really just this case of AI exuberance, particularly as those mega caps continue to power ahead. Yes, we did see some idiosyncratic price action on the back of the different reports, but ultimately, looking at the numbers, we have about 14% year-on-year sales growth for those companies. Margins are still above 20% and expected to continue to grow, and that's why we've seen kind of the NASDAQ, the S&P 500 post, fairly robust 4% gains year to date. Whereas the kind of the S&P 493 continues to be challenged because we aren't seeing that type of exuberance, really that broadening out that maybe you would have expected to other sectors.
But is this exuberance actually based on fundamentals, or is this, future earnings if AI is adopted at a very fast pace?
I think it's both. I think we certainly are seeing some exuberance being kind of driving that price action, but these is really the sector that's going to be profitable. I mean, clearly that came through in the numbers. So in this environment where, potentially there's uncertainty about inflation, about pricing, the policy path, you want to be in these tech sectors that are continuing to show profitability. The key risk I would watch for is really the real rates backdrop. We have seen them rise as those inflation kind of expectations ease further. And if those get kind of too high too quickly, that could curb some of this momentum. But I think that's probably something that's more of a tail risk at this point and really seeking the profitability in tech still going forward.
Okay, so you have a conviction call on U.S. tech, but you also quite like healthcare in developed markets.
Yes. So I think healthcare is an interesting dynamic in the sense that, positioning is light, valuations are actually quite reasonable, and it has that quality tilt. So in this environment, earnings disappointed largely because of those kind of post-COVID base effects, but this is still in a defensive sector. And if we kind of go a little bit more granular, looking at those key sectors that are actually going to benefit over time from artificial intelligence, like medical devices, for example, those are not yet accurately pricing in the potential impetus that's going to come from that AI development. So we are seeking exposures there because it is a defensive tilt in a still uncertain macro environment.
So what else, when you look at China and all of the volatility certainly that we saw in China today, is it likely to stabilize, or do you kind of make calls that are fairly immune to what China does?
So I think the recent price action in China is a mix of technical selling as well as a de-risking ahead of the Lunar New Year. We did see some of those reports come out that, we are going to see some measures to bolster sentiment. We don't think it's going to be enough to really add conviction that now is the time to increase Chinese equity exposures. But the key kind of question is, well, what implication does this have for European exposures overall because of its export-oriented nature to China? So we are still quite cautious overall on European equities, and it's about taking a really selective approach on a sector basis rather than seeking kind of the broad European equity benchmarks.
Brilliant, Laura. Thank you so much, as always, for joining us. That was Laura Cooper, BlackRock's Senior Macro Strategist for iShares EMEA. Now, the Turkish lira has softened after Turkey named a new central bank governor. The announcement comes as Gaye Erkan stepped down, blaming a smear campaign. Now, for more, we're joined by Selva Baharbaziki from Bloomberg Economics in Ankara. Thank you for joining us. So Erkan's exit from the central bank job has a familiar feel. Her four predecessors' terms were all cut short. Should investors be worried?
Morning, Francine. Yeah, Erkan's exit makes her the fifth governor whose term was cut short in the past 5 years. But unlike the previous instances, we think that this one has actually this time a different feel. We have two reasons behind that conviction. Number one, previous instances had seen the central bank governor change following a different view with the top management on the course of action for the central bank going forward. Well, this time around, we have Mehmet Şimşek firmly in place as Minister of Finance, overseeing the general policy overhaul of the country and having released now several statements in support of the current new governor who was appointed. That we see as an assurance that the orthodox policies are actually here to stay. Number two, Fatih Karahan's first act as new governor has been to release a statement, a hawkish guidance, I have to say, over the weekend, that he said that price stability is the priority and the utmost important objective that they're striving for.
So should we expect a shift in policies with Fatih Karahan taking over the top job?
Actually, we think that initially we had seen that the central bank was going to continue tightening, having reached a peak rate of 45 already in the January meeting, through alternative measures. We still think that that's going to happen. In fact, this morning just, the central bank released a move in reserve requirements that will nudge deposit and likely lending rates a little higher, even in the absence of rate hikes. But now, following this hawkish guidance from Fatih Karahan, we actually think that it's likely that the central bank will act more proactively if the inflation outlook worsens looking ahead. We just had January inflation announced this morning, just under 65, relatively sideways movement when we look at the annual figures. But on the monthly, it's a 6.7% rise. If that trend does continue, the outsized increases in prices, then we do think that there's now a higher likelihood of a rate hike coming our way.
Okay, Selva, thank you so much. Selva Bahar Baziki there with the very latest on Turkey. Coming up, UniCredit at an 8-year high after smashing profit forecast. We'll look at whether its peers can match that performance when they report this week. This is Bloomberg. Welcome back to the Pulse, everyone. Now, UniCredit, one of the biggest gainers on the Stock 600 today after profit beat estimates across the board. Now, shares at the highest in 8 years after net income came in almost triple of analyst forecast. Now, let's get more on this and the banks in general with our very own Tom Metcalf, who oversees all of our banking, I was going to say banking crisis, but also banking good news.
Both.
In Europe and the Middle East. Tom, thank you so much for joining us. I mean, this is pretty incredible. I mean, the stock price is gaining 9.8%. Like Orchel seems to have done it again. You know, what happens next?
Yeah, I think incredible is definitely the word. This is a big bank, and you look at its share price, 10% today. It's up, I think, more than 50% in the past 12 months. And, I think that's the big question is, Orchel is definitely delivering right now. It's really incredible numbers, 100% effectively of net profit going to be given back to the shareholders. No surprise, they're absolutely loving that. And the question is, what more can be done at UniCredit? If the intent is to try and keep up this pace of shareholder return, it's hard to see how they could achieve that. But no, right now they're in a very good spot.
Tom, do they have a growth? I mean, I know he has a growth plan, but actually, given all of the swings and the difference in like interest rates coming, does the growth plan hold, or will it continue having to be cost cuts?
Yeah, I mean, that's the interesting thing. That's the cost cuts are the things you can definitely sort of guarantee, as it were. But of course, having spent the last few years on that side of things, they really now need to find the growth if they really want to sort of push things forward. So I think that will be the challenge. But again, a lot just depends on this rate environment. We were talking just before, surely it will start to, we'll still see some cuts at some point. But right now, maybe it's going to take a bit longer than we thought.
Tom, on the other earnings, so we have UBS tomorrow, so we'll also take the show actually from Zurich because we're speaking to the chief executive. I don't know what your killer question to Sergio Armadi is. I mean, we have to wait for the earnings, but then you also have the French banks on Thursday. I think you have Société Générale and Crédit Agricole.
Yeah, well, look, I think the interesting thing about UBS is it's Q4 results, and at the same time they're saying they're going to have some kind of investor update. And for me, that's the real interesting thing about tomorrow is what will that constitute? It doesn't feel to me like it's a full-blown investor day, right? But where do they go? What kind of tweaks are they making to that integration plan? Or will it be the message which they've stuck very sort of strictly to is we're on track, we've laid it out, we'll keep on delivering. And it'd just be looking for any deviance from that, I suppose.
And on the French banks, again, I guess the question that comes over, and I saw Crédit actually Crédit Agricole, or maybe the other one, actually doing quite a lot of cost cuts. Again, trying to keep that, SocGen actually trying to keep that under control.
Yeah, exactly. So they come out today and said 900 job cuts, confirming an earlier story from a reporter in Paris. So, and again, it speaks to this bigger theme. You can see it with UniCredit as well, is how can Krupa, the SocGen CEO, kind of shape that bank into the sort of position he wants. So he's going down the cost cuts move. He's also looking at maybe some divestments. And I think, again, tomorrow will be interesting just to see, what comes out of some other French banks as well.
All right, we'll keep an eye on it. Tom and his team, of course, will be all over all of the earnings and all of the news. Tom Metcalf, they're in charge of banking in Europe and the Middle East. Now, tomorrow we'll be speaking to the UBS chief executive, Sergio Ermotti, as the Swiss bank reports earnings. So don't miss that interview. We'll play it out at 7 a.m. London time. We'll have plenty more, of course, on the markets today. The big thing we're watching out for is not only earnings. So we look at the banks, but actually we look at what's happening, or what has happened over on the Treasury side. So Treasuries extending a bit of a sell-off, the dollar actually rising. This is after the Federal Reserve Chair dimmed hopes for lower interest rates. Now, the Treasury declines sent waves through bond markets, also pushing some of the government debt, for example, down in Germany. Now, Fed Chair Jay Powell takes the March rate cut off the table and says the job's not quite done. China vows to stabilize markets after last week's stock slide. Meanwhile, Donald Trump warns he'll impose tariffs of 60% or more on Chinese goods if elected. Plus, UniCredit soars as the Italian lender smashes expectations and says it will return 100% of net profit to investors this year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, for more on what's moving the markets, we're joined in a second by Justina Lee and Ven Ram from our MLive team. So, Justina and Ven both join us. Thank you for joining us. Ven, if you're on the line, a lot of the focus, of course, is on what we saw with Treasuries. I understand that Jay Powell doesn't want to commit to March, and he may be pushing that beyond. But what do you make of that extraordinary jobs number on Friday? Does it mean that actually we could see, a cut not sooner than even June?
Yeah, absolutely, Francine, because I think the markets have taken back the rate cut that they were pricing in March. Now they're pricing in a fair bit of chance, 75% of a chance for a rate cut in May. And given what you said about the labor market, the data that we got on Friday, it suggests that even May may be too early, and June is probably where they are converging, the Fed is converging towards a rate cut. Those numbers that we got from the jobs market on Friday were extraordinary. 360 plus of jobs market growth is not something that you see in lean times. And you saw wage earnings accelerating at a 4% plus clip. Those are not suggestive of an economy that needs immediate accommodation, and that's what Powell is wary of, that inflation may reaccelerate in the coming months.
Yeah, and Justina, I really don't understand. It's extraordinary, and we know that there's a U.S. exception, but actually the economy adding 353,000 jobs in January. It's not only a stronger pickup. It's incredible that this happens when interest rate hikes continue to ripple through the economy.
Right, exactly. I think for the past year, we've heard a lot about how, over history, there have been very few instances when the Fed has been able to kind of tamp down inflation without also triggering a recession. And I think the question for economists here is what's kind of different about this time? Is it sort of the lingering effects of fiscal stimulus? Is it about kind of like technological advancement, coming from AI? And I think it's pretty clear that, earlier we were talking a lot about how the pandemic kind of messed up a lot of patterns, like maybe a lot of people saved up a lot of money, and so they're still spending. And I think really it's a mystery at this point, kind of continuing until early 2024.
Yeah, Ven, can you make sense of this? Again, how do you explain such a strong number, given where interest rates are and how fast they went up?
I think that the demand in the economy is still so resilient, and the jobs market still sees pent-up demand. And what Justina mentioned, there's this productivity-led growth, AI-led productivity growth in the economy, and that's a huge leg up for the economy. And that is what is keeping the labor market still buoyant. And I think that that'll continue to be the way for the next few months, which is why I think that even a May rate cut is not likely, and therefore June or probably later is when we'll probably get the first rate cut of the cycle.
So, Venna, in your piece today, which is brilliant as ever, you basically say that unless the labor market goes into some kind of abrupt cataclysm, we may not get a rate cut in May. Does that then push back also expectations for the ECB cutting and for the Bank of England cutting?
Absolutely so, Francine, because, the markets are still thinking that, look, the ECB may come out in April and cut rates. In the event that the Fed is not going to cut rates in March, there is no chance that the ECB is going to cut rates in April. They've already made that point clear. Philip Lane has made that point clear. President Lagarde made it clear in that interview with you in Davos, and the markets are still not buying that. I don't think we are going to get a rate cut in April from the ECB at all.
Yeah, and Justine, this also goes to the fact that actually inflation could be coming down, but I guess they want to see a protracted data to make sure that it's really coming down to where they need it to be. And if you also look at earnings, it could actually suggest that there's a bit of overheating.
Yeah, it's pretty interesting, especially with the U.S. Obviously, we kind of saw mixed numbers coming from the tech giants. But I think for some of the earnings, you're definitely kind of seeing a lot of secular forces at play that are detached from the ups and downs of the economic cycle. And I think that is one thing that investors really like. And that's why we've seen kind of a lot of money going back into the Magnificent Seven. It's not just about kind of capturing demand, it's also about capturing these trends that are there regardless of the cycle. I'm talking about like AI, obviously. Yeah.
So, Justina, when you look at all of the markets, what, apart from inflation and the Fed, is there anything else that will be a catalyst going forward?
Yeah, I think China is sort of a big question here. It had another really dramatic day where it was swinging between kind of like losses and gains. And the reason was that kind of in the end, the regulator kind of came out and said that they would deal with the liquidation risk coming from these like share pledges. And so at this point, there were a lot of people wondering, of course, they've been wondering this for the past year, like, are we at a bottom? Are we going to see kind of more forceful stimulus kind of coming from Chinese authorities? And of course, that's going to kind of have an effect on like commodities and a lot of more cyclical stocks as well.
And Ven, what does that mean for, if you look at Treasuries, they looked at the U.S. jobs numbers and they looked at Jay Powell's interview. Again, what will inform them next? Are we going to see a lot of volatility as they adjust and adapt to new Fed speak?
I think we are going to see a lot more volatility in the front end because the 2-year maturity is kind of still overvalued at current levels, despite the correction that we got on Friday and the ongoing correction today. I think that they are still overvalued. There is some 15 basis points to catch up on fair value. I think that's going to happen in the next week or so. The 10-year yield, I'm not too sure it's going to go further from here because, if you look at an inflation premium of 1% from current inflation levels, 10-year Treasury is around where it needs to be, which is around 4%. So I don't think there is going to be a major sell-off or volatility in the long end of the curve, but in the short end, yes, for sure.
So, Justina, watch for VIX, watch for inflation numbers. I guess PMIs are we're going to be like red alarm on PMIs and any kind of data that comes out.
Yeah, I think kind of like leading surveys are kind of give a sense of kind of whether we're seeing a lot of the lagged effects from monetary policy coming through. I think one interesting thing in the market this year is that even though they've been kind of going up, especially in the U.S., a lot of that has been driven by, as we say, kind of these big tech names and kind of a more defensive style, what we call quality stocks. And so it's not necessarily that there is kind of a huge risk appetite for necessarily riskier plays. And I think whether we'll see a bit of that rotation will be interesting as well.
Great. Justina and Ven, thank you both for joining us. Justina Lee and Ven Ram from our MLive team. Now, coming up, the U.S. vows more strikes against Iran's forces and its proxies in the Middle East. Plus, Israel Benjamin Netanyahu hits back at criticism over U.S. relations. We discuss that next, and this is Bloomberg. So the Houthi rebels in Yemen have vowed to respond to the bombing conducted by the UK and US forces on Saturday. It comes as the Biden administration warns of further strikes against Iran's forces and its proxies, with U.S. National Security Advisor Jake Sullivan talking of a sustained but not open-ended campaign. Now, to bring this all together, I'm here with Bloomberg's international affairs columnist, Mark Champion. So, Mark, thank you so much for joining us. Looking back at, what happened over the weekend and the strikes carried out by the U.S. and the allies, were they effective?
Well, it depends on what you are trying to achieve. What the goal is. So I'm sure, militarily, I'm sure they were effective in the sense that they will have, been targeted and they'll have hit their targets. And some they will have degraded, some level of the ammunition stocks, the infrastructure, and so on that these militias have. Whether or not, then the second question is whether it's going to deter either these militias or Iran from continuing with the kinds of strikes that they've been doing. And that is much less likely. And in fact, overnight there was a militia attack on one of the U.S. bases in Syria where there are U.S. troops, but also Kurdish troops, and 6 Kurdish troops were killed. Another drone attack. I mean, the fact is that these militias are now armed with drones that allow them much more reach than they used to have.
Mark, U.S. officials say they won't be dragged into like a prolonged or protracted, war or regional conflict. But what are the risks?
The risks are definitely there. Every time there's a strike, the risk of a counterstrike that is too effective or is not expected, that always exists. I think for now it's very clear that the U.S. from the signaling it did, from the time that it took, from the way that it's making clear that it's not hitting Iran directly, all of that, it makes it very clear that the U.S. does not want to escalate, and the Iranians know it. The Iranians also have made it clear they're not in for a war. That's not what they're looking for right now. But there's a lot of players that out there that neither side fully controls. So it's it is dangerous. But for the moment, neither of the major players wants to see this escalate. So they'll do what they can to prevent it from doing so.
Are we any closer to a ceasefire in Gaza and the release also of the Israeli hostages?
Well, there are talks, going on, as we know, and they're going to be really difficult. Jake Sullivan said so as much over the weekend. I think at the moment, what the Israelis and the Americans are saying is that the ball is in Hamas's court, that the Israelis have made a proposal. It's now up to Hamas to respond. So we'll see. But it's clearly not imminent. But it is kind of vital if this risk of escalation is to start reducing. You're going to have to see something happen in Gaza that reduces the level of warfare there.
Do you think, Benjamin Netanyahu stays in power, given all of the criticism?
In the medium term, I think he's got a mountain to climb to stay in power. But in the short term, so long as the war is, as intense as it is, he seems to be safe.
All right. Thank you so much, Mark Champion there. Our Bloomberg opinion columnist covering Europe, Russia, and the Middle East. As always, also read his columns that are on the Bloomberg terminal, but also on our website. Now, attacks on commercial ships in the Red Sea have also prompted companies to test ambitious new land routes through the heart of the region. So one proposed route will take goods from India, the UAE and Bahrain through Saudi Arabia and Jordan and on to Israel and then to Europe. Well, let's bring in Bloomberg's Paul Wallace. So, Paul, who is trying to use these routes?
Hi, Francine. Well, we're seeing some Israeli logistics startups proposing this route from from Bahrain and Dubai chiefly all the way to Israel's Mediterranean coast. And there are also some slightly different routes, land routes proposed. Hapag-Lloyd, the big container shipping company, is also looking at offering clients routes from Bahrain and Dubai to the northern Red Sea, to Saudi Arabia's western coast and the northern Red Sea. Essentially, both of these routes are to avoid the southern part of the Red Sea, where these Houthi attacks have been taking place. And it's still sort of a niche proposal at the moment. There's been news that some sort of chemicals and some electronic goods are going to be moved by truck from Dubai to Israel. But I think for the vast majority of goods, that's not really economically feasible and wouldn't really save much time. But the existence of them shows just how worried shipping firms are. And I think it also underscores that they think this is going to last for a long time, for many more weeks, if not months.
So, Paul, first of all, are these, if you look at these routes, and you're kind of intimating that commercially and politically they're a little bit difficult, what are the wider implications of these attempts, to try this route?
Well, I think that the goods that will go on them are probably goods that customers in Europe are happy to pay a premium for, maybe to get them a few days earlier than they would if these goods went around the Cape of Good Hope. Around the southern tip of Africa. So that's probably something that customers who want to pay a little bit more can use this. Politically, if this route works, particularly the one going to Israel and its main port of Haifa north of Tel Aviv, politically that would be significant. Because although Bahrain and the UAE, where Dubai is, have relations with Israel, formal relations, as does Jordan, which borders Israel, Saudi Arabia doesn't, and all these land routes require going through Saudi Arabia. If the Saudis are willing to let trucks go through their territory towards Israel with minimal paperwork, and they don't insist on things like the goods having to change trucks at the border with Jordan, then that would be politically significant, and yet another sign that the Saudis are moving towards sort of formal recognition of Israel. So beyond just the existence and beyond the trade implications of this route, I think it would be politically significant if it works, and a lot of people end up using it.
So interesting. Paul, thank you so much. Paul Wallace there with the very latest, of course, on these shipping routes. Now, coming up, Germany tries to revive its sluggish economy by trialing a 4-day working week. We'll discuss whether it will work next. This is Bloomberg. So Germany is attempting to revive its sluggish economy by cutting working hours. Dozens of companies are taking part in the trial of a 4-day working week. Now, it follows similar pilots here in the UK and across Europe. Our very own Oliver Crook is in Berlin with all of the details. Ollie, I mean, for some it's a dream. For others it says, well, it just means that you're doing, 5 days work in 4 days. So take us through the project and what they're actually hoping to learn.
Yeah, so I talked to the director of the project, and that was my first question, was really, what is the architecture, what's the structure of this program? And actually, the goal is, Francine, to work less, to get people to work less. It's a 4-day week, same amount of pay, but less work across the board. It's to make the employees healthier, to make them happier, but also to boost productivity. So it's across 45 companies across Germany. This will go for 6 months, and then afterwards they're going to sort of reap the data. And it follows similar things in other countries, but notably, Francine, in the UK, where they did this demo for 6 months, and 92% of companies that participated decided to extend the trial of the 4-day working week on beyond that. So I actually think that that is actually, sort of an interesting thing. I'm not sure that the dynamics will be identical in Germany, but we'll see.
But so how skeptical are Germans of this idea?
I mean, I think it depends on the Germans that you ask, but I will tell you there are a number of people that I've spoken to, whether it's politicians, people in business or in lobbying groups. They say that the main problem with Germany right now is people don't want to work that hard. So this is definitely one part of the population that believes that. And I'll quote Christian Lindner here, the finance minister, saying, "Never in history has a society increased its prosperity by working less." So this is the question I put to Carsten Meyer, who runs this program here in Germany, and here's what he had to say to that.
Christian Lindner is focusing more on a macroeconomic perspective. So if everyone has a 4-day week, obviously we'll have to think about different challenges. But in our test, it's more focused on the different specific companies who want to outperform their markets by actually saying we are better in terms of an employer than someone else.
And so while this may not result in net output that is higher, it will be higher productivity. But what's interesting, Francine, is really at the heart of this, these are companies that are asking to do this. Why? Because of the labor shortage. They cannot find the people that they need to do the jobs that they need done across Germany. So what do? They say, hey, listen, come work for a 4-day week, and that will encourage them to get the best talent here in Germany, where they say that they could be missing 7 million people from the labor force by 2035. So this is a major issue here.
So wait, what day are we taking off, Ollie? Because that's really the question. Do you take a Monday? Do you take a Friday?
So we've been all over this. Some people even suggested Wednesday. I mean, maybe that's completely nuts.
I'm a Wednesday girl.
There's some logic there. Yeah, you're a Wednesday girl? Okay. I think I'll take Friday off.
Yeah. Okay, there you go, Ollie Crook. It's a deal. Oliver Crook in Berlin with this trial of a 4-day working week in Germany. Now, the earnings conversation continues all of this week. Some of the biggest oil and energy companies release their data. Luxury rounds up the week after a mixed reporting season for the sector so far. So to discuss all of this, we're joined by Bloomberg's Chloe Mellet. So Chloe, what will investors actually be looking at when there's big oil? So we have TotalEnergies and Equinor and BP.
And BP, yes, exactly. So as always with big oil, the focus is on buybacks. So what we've seen so far is a slowing pace of buybacks. So we're still seeing very resilient, very massive numbers, really, both slowing pace. And fourth quarter earnings will not be record breaking, but they should be fairly resilient.
So luxury, I mean, luxury did really well, and then there's a lot of questions about luxury. What are you watching out for this week?
So far in terms of luxury, we've had a bit of a 50-50 split with LVMH and Richemont doing really well, and then Burberry issuing a profit warning, for example. So it's a bit of a mixed bag, and it seems like brand positioning and pricing power really is at the core of who's doing well and who's not. We've got Hermes that should be on the winning side this week, and then for Kering, who owns Gucci, it's a little bit more of a less of a rosy outlook because it's going through a brand turnaround.
Chloe, in general, do you feel like actually sectors, it's not really a sector stories, but it is really a company story. So if you have the right products, people want to buy it. And actually, if you don't, then you get slammed.
Yes, absolutely. This is what it seems to be about. And this is what Gucci is going through at the moment, trying to find the right audience, really.
So interesting. Thank you so much, of course, looking at some of the earnings there, Chloe Mellet. Now, we're also looking at UniCredit. This is a stock that's gaining 7%. I think it was gaining 8.5% actually just a short while ago. But the profit beat did also raise shareholder returns. So you can see UniCredit gaining some 9.9%. Tomorrow, we'll also be speaking to the UBS chief executive, Sergio Armotti. This is as the Swiss bank reports earnings as well. The other thing we're looking at is Treasuries extending their slide, and this is dollar rising as Federal Reserve Chair Jay Powell dimmed hopes for lower interest rates. The Treasury decline sent waves through bond markets, pushing down government debt from Australia to Germany. The dollar also strengthening against most of its major peers. European shares, you can see a little bit higher, but U.S. equity futures actually declined. Comments from Jay Powell underscored how policymakers are really trying to push back against some of the expectations for interest rates to fall early in 2024. Up next, it's Bloomberg Brief with Danny Berger and Manus Cranny in New York. This is Bloomberg.